The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar, a CARES Act update. The webinar will last approximately 15 to 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
Thank you, Jennifer, and welcome everybody. I'm glad you're here today, and I hope everybody is staying safe. We're going to talk today about the update to the CARES Act. The IRS published about a month ago a couple of notices that did clarify and expand the scope of some of the things in the CARES Act, and these things are good for us to know the details of as we work with our clients. But before we get into that, let's decide what we're going to talk about next month. The screen shows you the three choices, and they are ethical issues with incapacitated clients dealing with terminal illness. And then the third one, lies, damned lies, and life insurance illustrations. That's going to be on Wednesday, September 2nd. We're going to go ahead and open up the poll and allow you to vote. Please vote for your choice out of those three, and that will be what we cover next month. I'll give you about 30 seconds to do that. Please go ahead and vote now. Still waiting for a few more responses. Take another 10 seconds. Thank you for voting, everyone. We'll go ahead and close the polls. The overwhelming choice is lies, damned lies, and life insurance illustrations. That's hardly a surprise to me, but thank you for doing that, and that's what we'll talk about next month. If you have already marked your calendars, great. If not, please do so for Wednesday, September 2nd, 2020 at the same time, 11 o'clock Central. We have these free webinars the first Wednesday of every month, and if you have an interest in being invited to all of them, make sure that you subscribe to our YouTube channel, and we'll show you how to do that at the end of the session today. Let's go ahead and get into the content that we promised. This is really an update to the CARES Act. There were two IRS notices that supplemented the CARES Act. Just as a reminder, the CARES Act was implemented earlier this year. Seems like forever ago, but it was just earlier this year, where the federal government provided some direct financial assistance to individuals, also some indirect aid to individuals who have been affected by COVID-19. And the legislation also provided some incentives to employers that were designed to help, in part, to keep people employed. And then there were some other miscellaneous provisions expected to help stimulate economic activity. And we've certainly talked about some of the provisions of CARES, including the pension or the payroll protection program. But we're not going to talk about that today because the notices really don't deal with it. What we are going to talk about today is, first of all, we're going to talk about the COVID-19 related distributions. COVID-19 related distributions are available of up to 100 grand from IRAs, and those waive the penalty tax. They're also available potentially from employer-sponsored plans if the employer agrees that the pension plan is going to comply with the COVID situation or the COVID standard. Up to 100 grand is available in service for those who certify that they've been affected in this way by COVID-19. In the CARES Act, the COVID-19 standard is the taxpayer was affected, spouse or dependent was affected, and the shape of the being affected was you either had the disease or you were quarantined, you were furloughed, you were laid off, you had your hours reduced, you had to stay home because of health care. But the thing that was ambiguous for us is that there were some other factors that might also be determined by the IRS, the Treasury Secretary. Well, in the notices, the IRS did expand the standards. And so let's talk about what that means. First of all, on June 19th, about 6 weeks ago, the IRS issued Notice 2020-50, which clarified the standards. 4 days later, the IRS issued Notice 2020-51, which dealt with some of the rules around the waiver of required minimum distributions, which was also a big part of CARES that affect us and our clients. And these are both really important for us to understand and to explain to our clients. So let's start with 2020-50 and let's talk about what happened. Well, in 2020-50, the IRS clarified and expanded the scope of COVID-19 triggering event. Spouse or dependent diagnosed with the virus, that is pretty much the same as it was in the original legislation, although it did clarify how that diagnosis needed to take place. But what also ended up being part of Notice 2020-50 is that anybody in the individual's household who has been affected by COVID-19, that ends up being a trigger. Doesn't necessarily have to be a dependent. In addition to that, people who have been who are self-employed, who've had their income reduced due to COVID-19, that's a trigger. Somebody who was offered a job prior to the COVID-19 social isolation, social distancing, and had that job offer rescinded or the start date delayed, that also ended up being a trigger for COVID-19. And not only the individual having that happen to them, but also somebody in the household, right? Not just spouse, not just dependent, but somebody in the household had that happen to them. Those ideas are new. And so for our clients who need money, who have a qualified plan at their current employer, who want to access the money, there are now extra standards, and it's worth it to us to go visit with those people to figure out whether or not they might qualify under the expanded standards that have been put forward by the IRS. Now, I mentioned this earlier, not every employer has to embrace the COVID-19 distribution standard. However, if an employer has sponsored a 401k, 403b plan, they can say yes to this even without updating their plan document. And so if you've got a client who has access to 401k or 403b plan, they should check with their employer to find out if COVID-19 is a trigger for immediate eligibility for distributions. If yes, 100 grand is the maximum amount they can take out, or their account balance. If it is less, they can't automatically manufacture more money in their account. There's no requirement that the employers give access to in-force people, but a lot of them are doing this as a way to help their employees indirectly. And if they do, then they can provide access. And essentially, to get at the money, the employee's got to give the employer certification that they've been affected by COVID-19. The employer doesn't have to do any additional investigation. They just have to get a certification from the employee. Now, if they know about the fact the employee hasn't been affected by COVID-19, they can refuse, but they don't have to do any investigation other than getting a note from the employee saying that the employee is eligible under the standard. So COVID-19 distributions can be made anytime during 2020 if the distribution is either from an employer plan or from an IRA. The income tax can be paid over 3 years. The income is included over a 3-year period beginning with 2020. And also, you've got an extended ability to roll over the COVID-related distribution into a qualified plan within that same 3-year deadline, within 3 years of having taken the distribution. And so if it's been taken from a qualified plan, the rollover, the recontribution rollover can be done into any eligible retirement plan, including an IRA. And recontributions of coronavirus-related distributions will not be treated as rollovers for the purpose of the one rollover per year rule that applies to IRA rollovers. So it doesn't count against that limit. So that's good news for our clients, certainly something for us to talk about with our clients. If our clients take a distribution, they're going to get Form 1099-R for their distributions. They might get 1099 Code 2 in Box 7. Early distribution exception applies to alert the IRS that they shouldn't be expecting to collect a penalty tax, or distribution Code 1. Early distribution no known exception. That's up to the plan administrator. So no one should be surprised about getting 1099-Rs. Early distribution penalty is waived, as I said earlier. And another little piece of good news is if somebody is taking 72T distributions, this usually happens from IRAs, the receipt of a coronavirus distribution is not going to be treated as a change to those 72T distributions. So that's good news. So we've gotten a lot of questions here at Advanced Underwriting Consultants about this 3-year spread out of income tax result if somebody's eligible for a distribution. The most creative idea that we've kind of heard is, well, why doesn't somebody take a 401k plan distribution, convert it to a Roth IRA, and spread out the income tax result over a 3-year period? That seems to be okay if they're coronavirus eligible for a distribution, and if the plan administrator says they're going to participate, the employee can take the distribution out. Because a rollover is allowed, a conversion also seems to be allowed. And so, this idea of a Roth conversion with a 3-year income tax result seems to be all right. Nothing in the guidance seems to prevent that strategy. Although I guess you got to take some care in talking to your clients, because the federal government seems to be modifying and enhancing these rules on an ongoing basis. It's possible that they'll decide that Roth conversion is going to be abusive, and they may step in later and do something about perceived abuses. So I guess we need to tell our clients about that. But it appears the technique does in fact work. So let's shift focus now. Let's talk about Notice 2020-51, which came out a few days after 2020-50. Now, in the original CARES Act, most RMDs were waived for calendar 2020. There was an indirect rollover corridor that allowed for qualified plan distributions that were taken February 1st or later to be rolled over by the tax return deadline of July 15th. And the new notice has actually clarified and liberalized the indirect rollover rules. And so the one negative is that the notice says that defined benefit plan distributions are still not eligible for rollover. They were not eligible for rollover before. Even though RMDs have been waived for this year, they are not eligible now. So defined benefit plan distributions are not eligible. So that's a confirmation, I suppose, of some bad news. Let's talk about the good news. The first piece of good news is that there are liberalized rollover rules. And so amounts that were previously believed to be RMDs that were taken in 2020, even if taken in January, may now be indirectly rolled over into a qualified account on or before August 31st of 2020. So there is a liberalized rollover deadline. Our clients still have about 4 weeks left. If they took an RMD and decided they don't need it earlier in 2020, they've still got the ability to do a rollover, complete a rollover by the end of this month. And the notice says that if you do that, it doesn't count against your one rollover per year indirect IRA limit. And so any amounts taken may be redeposited without counting against the one per year rollover limit. So that's the first sets of good news. Any distribution previously thought to be an RMD is now eligible for rollover if the client acts before the end of the month. The notice does not extend the special rollover date to amounts taken that were in excess of the minimum distribution. So that's important to know. It's not just any distribution that qualifies for the extended rollover date. It is only amounts that were previously thought to be RMDs. If you qualify for the waiver of RMD and you took one, and you also qualify for COVID-19, you may get a 3-year extended rollover deadline, but that's not available to everyone. It's only those COVID-19 eligible people. And then one of the surprising things is that apparently, I say apparently, it is in the act. If you've got a non-spouse beneficiary of an inherited IRA, the notice specifically says you can do an indirect rollover back into the plan of the RMD. So if you took an RMD from an inherited IRA account back in January for 2020, you can redeposit that amount before the end of August, and that's a valid indirect rollover, right? And so that's good news. It's something that we didn't necessarily expect, but it is certainly something that we can go talk to a lot of our clients about. If they're non-spouse beneficiaries of inherited IRAs, and if they took a distribution earlier this year, then they have an unexpected potential relief by being able to redeposit that money. So what effect does the 2020 waiver of RMDs have for accounts for future RMDs taken from those accounts? The answer is not much. We're just going to pretend 2020 happened in 2021 and it happened properly, and you're going to deal with 2021 like everything was normal in 2020, like there was a normal distribution, like there was a normal required beginning date for the contract. All of that will proceed as normal, even though RMDs were not actually taken in 2020. So there will be no real effect on future RMDs, future RMD rules after 2020. 2020 is in fact waived, but anything that happens in 2020 and beyond will proceed normally as if 2020 happened normally. Doesn't change really most of the deadlines for decedents. For example, somebody who dies in 2020 with a non-spouse beneficiary, well, that non-spouse beneficiary's got to liquidate the inherited account by the end of 2030. You don't get an extra year because 2020 RMDs were waived. It's just your required beginning date is normal. So that's interesting, and there you go. So what's ambiguous here? I think we've got an opportunity to talk to our clients about that. 2020-51 doesn't answer everything. What the language of the notice seems to say that is that if you took an RMD from an IRA, not from a qualified plan, but from an IRA, the distribution's got to go back into the same IRA. And I don't think that that's what Treasury meant to say. Seems to me that they would have allowed for the deposit of a faux RMD into another IRA or into an employer-sponsored plan by indirect rollover, but the language of the Act seems to say that it's got to go back into the account from which it came. And so that's ambiguous, and so you should be aware of that. You should be aware of how the carriers that you work with are dealing with that, and if they force you into the account from which the RMD came, you'll know why. It's because there's some ambiguity here in the language of the notice. We'll see if we get another notice that clarifies this later on. Both Jennifer and I feel like that interpretation is not what was intended, and we will get clarification there, but that's not a for sure thing. So that's why the carriers are being conservative, I think. And so then there are other ambiguities as well. So this is just more information on this slide. This is just more information about the ambiguity over whether the deposit has to go back into the original IRA or not on a faux IRA distribution. So while the Act does say that inherited IRAs now allow for indirect rollovers of the faux RMDs taken earlier this year, we don't know whether the same is allowed for inherited employer-sponsored plans. The notice doesn't mention those types of accounts. It does mention inherited IRAs specifically. It does not mention employer-sponsored inherited accounts, and indirect rollovers from them. It probably means that it's safe to assume that that is not possible. So if a client was a non-spouse beneficiary of an inherited employer-sponsored plan, took an RMD this year, probably indirect rollover is not required. or is not allowed. That's our best guess. We may get clarifying legislation on this. We may get clarifying notice from the service on this, but the safe answer is that on an inherited employer-sponsored account, indirect rollover is not possible. So what are the conclusions that we should take away from this pair of notices? Well, the CARES Act was complicated, and if we were on the ball, we probably talked to our clients about the possibility of indirectly rolling over a faux RMD by July 15th. Well, we've got an extended due date for that. It's now August 31st. So for our clients that we might have missed or perhaps couldn't make an indirect rollover by the July 15th deadline, we've got an opportunity to go talk to them about making the rollover by August 31st. Also, where we have non-spouse inherited IRA accounts where they took an IRA or where they took an distribution, an RMD distribution earlier this year, we've also got an indirect rollover opportunity, which we didn't expect. And so for our beneficiaries of IRAs, we've got something to go talk to them about. And you know, for all of our clients who may have a financial need, who are employed, who may have access to qualified plan monies, the new rules in 2020-50, the clarification of who's eligible for COVID-19 distributions, that's certainly something to talk to them about. So we absolutely have a reason to go visit our clients, have an opportunity to tell many of them reasonably good news, and we've got an opportunity to serve them when they're potentially going to be in dire financial straits. We've got an opportunity to help them access their own money in ways that they didn't necessarily expect, so that they can help themselves and help their families deal with the effects of COVID-19. So at this point, I would like again to thank all of you for joining our webinar. I would like to turn the program back over to Jennifer, and I would invite you, before I leave, to please subscribe to our YouTube channel. Jennifer?
Thanks, Linus, and thanks for joining us today. And don't forget to join us on Wednesday, September 2nd for Lies, Dan's Lies and Life Insurance Illustrations. And as a reminder, if you would like to receive supporting materials for today's webinar, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.